Scott Pape warns of a housing bust. Let's have a look. Hello everyone, Florian Heiser here and welcome to another episode of Heiser Says. Grab your stein of coffee. Let's have a look at this article discussing a warning from the Barefoot Investor about Australian housing. A bubble is set to burst. So, Barefoot Investor warns Australia's housing bubble is set to burst and exactly what will cause a dramatic drop in prices. Okay. Financial guru Scott Pape has warned Australia's housing bubble is set to burst and Australians wouldn't want to end up to their eyeballs in mortgage debt when it does. Pape, better known as the Barefoot Investor, noted in his blog interest rates, which are at record lows, will rise, and when they do, they'll burst the housing market bubble. Australian houses and apartment prices have risen dramatically, with a 22.2% increase in the year to November, marking the fastest annual surge since 1989. Okay, so what is a burst of the bubble? What does he mean? Does it mean that the bubble will burst and prices will crash, or the bubble will burst and the growth will stop? So we'll just sit at property will plateau for a decade. Property values are growing at 10 times the rate of wages growth. CoreLogic data showed the national value of homes had increased for 14 consecutive months, with the median price increasing by $126,000 in the past year. Remember, that comes off the back of a correction too. We had property go down and now it's climbed back up again. Australia's mid-range property price of $698,000 is now so dear an average full-time worker earning $90,000 will be in mortgage stress even with a 20% deposit. Okay, now, this is pointless. Okay? That sentence that they put here, it's completely pointless. It doesn't matter. Because houses were bought always with a household. Now, back in the day, in the old days, in the good old days, back in the day, you'd have one person, one worker earning enough to support an entire household. Now that doesn't exist anymore. So you need two people earning $90,000. That's $180,000. They'll be fine. Okay? That's the difference. You need the household should be a couple, and they both should be earning decent average money. Then they'll be able to service that loan. One person buying a house, that's not a modern household, or maybe it will turn into it, but then you've got to earn more. So, that's because the Australian Prudential Regulation Authority, the banking regulator, considers debt-to-income ratio of 6 or more to be dangerous. In Sydney, housing prices have surged by even more dramatic 30.4% in the year to November, taking the midpoint to a very unaffordable $1.3 million. In his blog, Pape answered a question from a reader who asked why they were finding it so hard to buy a house. My fiancé and I both earn good money. We have a healthy deposit and budget and want to buy so we can start a family, the reader said. We offered more than what we were asked and were told no. The vendor took a cash offer instead. Well, can you blame the vendor for doing that? They want to minimize their risk. They don't want to do it subject to finance. This person needs to move somewhere else. Okay, that's it. There's affordable property there around. You just got to be less picky. That's what it is. Go somewhere cheaper, live there, do it up, get some equity, sell, then make the cash offer. Okay? So, I obsess over realestate.com, ringing as soon as something comes up, only to find it was sold or waiting to be uploaded to the site. They added that they called real estate agents for help and told them they were pre-approved first home buyers, only to be ignored. The dream of owning your own home must feel like a heart-crushing unlikelihood. He told the reader not to give up, adding he believed the housing market bubble would eventually burst. I've no crystal ball, and picking short-term economic moves is a mug's game, he said. Yet it gets clearer when you zoom out. He pointed out the Reserve Bank of Australia interest rates in 1990 stood at 17.5%, and they were now at a record low 0.1%. The RBA slashed the cash rate in late 2020 to offset the financial effects of border closures and lockdowns. It also gave $188 billion to the banks via the Term Funding Facility to provide cheap home and business loans. Low rates have spurred demand and pushed up prices. Both the Commonwealth Bank and Westpac are expecting property prices growth to slow in 2022 and fall in 2023 as the RBA raises rates. Okay, they're expecting growth of about, 5 to 6% in 2022 and then a 5% fall the year after. It's still going to be well higher than what we were complaining about back in 2019, guys. When I first started this channel, when I first started talking about property, we were bitching about housing affordability. And even if we go back to those levels, which would be considered a correction, it's still going to be an affordability issue. And if you're thinking, okay, well, how do I get a property by myself? What you do is you live with your parents. That's what every example that we have in all these gurus that make a fortune. Over-leveraged borrowers would also struggle as standard variable rates increase. He said he'd asked his 8-year-old son where interest rates would go, and he replied, up, they can't get much lower. So when interest rates rise, and they surely will, it'll be brutal for many people who've borrowed too much, he said. I can't tell you when that will be. The only thing I can say with great certainty is that you don't want to be up to your eyeballs in debt when they do. Okay. Now, many people are seeing this, are just waiting for interest rates to go up, and then all these gullible people that have taken on these huge loans to come crashing down. Okay, there are going to be some. There will be some that are probably investors that have over-leveraged into multiple properties, maybe interest only, and what will they do? They'll jack up the rent. Maybe they'll sell one property. But we're not going to see a flood of them hit the market, guys, because the banks will stop it. They'll do what they can to mitigate that. They've already been tapping people on the shoulder now, because they don't want their assets to plunge in value. So just keep that in mind. And people will do what they can. The banks have already accounted for a buffer in anyone they're lending money to, of 3.5% above the current rate, that you should still be able to do it. You may not be able to live the life that you're showing off to the neighbors, but you'll still be able to do it. What it's going to do, it's going to have an impact on the wider economy. It'll have an impact on retail spending. So, CoreLogic's research director Tim Lawless said it was already evident that the pace of growth was slowing. Virtually every factor that has driven housing values higher has lost some potency over recent months, he said. Fixed mortgage rates are rising. Higher listings are taking some urgency away from buyers. Affordability has become a more substantial barrier to entry, and credit is less available. Record low interest rates and the ability of more people to work from home has seen a surge in demand for houses, causing prices to rise in both capital cities and regional areas. Across the capital cities, Melbourne's growth is slower than Brisbane and Adelaide, which are still going strong. Hobart, Sydney and Brisbane have the biggest value increase in the last 12 months of 27.7%, 25.8% and 25.1% respectively. While Perth at 14.5% and Melbourne at 16.3% have had the smallest. Reserve Bank Governor Phil Lowe has hinted the cash rate, now at a record low 0.1%, could rise in 2023 instead of 2024 as earlier promised. That's why we all fixed our mortgages, because none of us trusted him. The major banks are forecasting a rate rise in 2022, with none of the big four lenders offering fixed mortgage rates less than 2%. So let's have a bit of a talk to this one, guys. So the bubble, according to Scott, is going to burst, guys. But that doesn't mean prices are going to come tumbling down. If you're there waiting on the sidelines, sitting there waiting for your money, trying to jump in, trying to time the market, it's bloody hard. Guys, timing the market, I mean, come on. Can you do TA on housing? Can you time the market? Can you predict it? And remember, it's housing. It's not stock. People aren't going to be squeezed out as fast as other things. They'll go on a current affair and bitch and moan. Then the government might, hey, if there's a recession, remember, it's an election year next year. So what do you think the government can do to prop up the market? So, I mean, what you have to do, if you've borrowed a lot of money, you need to plan for an interest rate rise. You need to expect rates to be hitting 5% on your mortgage to repayments at a minimum. Plan for that now. Prepare for that. Make sure you have multiple income streams. Make sure you have money put aside. People have been paying ahead. I mean, 30% is the definition of your gross income as mortgage stress. If you're spending that on your house or your rent, your mortgage, are you already there? Do you feel stressed? Could you handle 30, 40, 50, 60? What would you have to sacrifice? That's what people are going to ask, guys. They're not just going to sell straight away. So we'll have to see. I would not be shocked if prices stagnate. Well, at least in Sydney and Melbourne. I'd be shocked if they do in Brisbane, to be quite honest. Anyway, guys, thanks for watching. And check out this video about property predictions for 2022. Take care, have a great day, and I will see you all in the next episode of Heiser Says. Oh, it's good coffee. I'm running out.